I've got £50,000 saved up, but is that actually enough to buy property? It's the question we get asked more than any other. And we completely understand why people are confused, because depending on who you ask, you'll get wildly different answers. Some people think 50k is massive money that opens up loads of opportunities. Others believe you need 100k minimum before you could even think about investing. And if you live anywhere near London, you'll probably think a decent property starts at about £500,000. But over the past 12 years, we've helped arrange thousands of property purchases for people with budgets just like yours. So in this video, I'll break down how to make 50k stretch further than most people realise, the 3 areas in the UK where that money performs best, and how to spot the red flags that can ruin your returns before you've even started. Now, before we look at the best places to buy with this kind of budget, we need to figure out how far 50k will actually go, because we tend to find that people have wildly inaccurate perceptions of how much they need. Some people say, I've got £10,000 and think that it's loads. Others have 100k plus and are convinced it's not enough. Those who assume their money won't go very far are often from London and the southeast, where you can easily pay £500,000 for an uninspiring studio flat. So, of course, their perspective is skewed. But this mindset can stop investors from taking their first steps in property, and it's a huge missed opportunity. Because when you understand how leverage works, even 50,000 can actually go a very long way. When you take out a standard 75% mortgage, you're effectively multiplying your money by 4. And once you've bought an investment property, you make money based on the growth of the total value of the property, not just the part that's your initial investment. So far from taking out a mortgage reluctantly and wishing you could buy in cash, instead, this leverage is actually one of the biggest advantages of property compared to anything else you could invest in. But of course, in practice, you need to consider stamp duty, legal fees, and cash set aside for maintenance. And if you're doing a refurb, you'll need even more cash up front. So to be on the safe side, we like to multiply the deposit by 3 rather than 4 when we're calculating an investor's buying power. Meaning that with £50,000, you're looking at a £150,000 property. This might not sound like a lot, and sure, it's great if you have got a bigger budget to play with. But it's definitely workable once you know the places to get the most bang for your buck. And by the way, this is something we explore in more detail in our free expert investment toolkit. It includes a list of our favourite investment locations, a step-by-step process to assess particular areas, and a whole lot more. It is completely free, so to get your hands on it, just click the link in the description. So once you understand what 50k can buy you, the next step is knowing where not to spend that money. And this is where a lot of first-time investors trip up. They often want to go as cheap as they possibly can, because with property you're tying up a scary amount of money, so it eases their anxiety when they look at the very bottom end of the market. So they sort Rightmove by cheapest, start scrolling through listings, and book a viewing for the first house that looks half decent. We've seen this line of thinking guide investors towards places like Redcar in North Yorkshire or Everton in Liverpool. In some cases, in places like this, you could even skip the mortgage and buy a house for £50,000 in cash. But cheap doesn't mean good value, because in these areas there's a high risk that you'll be dealing with constant repairs, unreliable tenants, and little to no capital growth. Every month you're fighting maintenance and payment issues while the property's value barely moves. These properties are cheap to buy but expensive to own, and some places are cheap for a reason. At the other end of the spectrum, some people try to stretch their budget into the outskirts of London, thinking that a £150,000 studio flat will get them on the ladder. But these types of investments are usually niche, hard to get a mortgage for, and come with poor growth prospects. You might even find yourself dealing with problem leases or low quality builds in areas tenants don't really want to live in. So the goal isn't just to buy whatever's within reach, it's to invest where your money actually works hardest for you. You want the right balance of affordability, growth, and reliable tenant demand. As we've seen, a 150k budget doesn't go far in London, and in really cheap areas, you'll pay in stress rather than returns. So the trick is to avoid chasing low sticker prices or prestige postcodes. Instead, focus on areas where £150,000 secures a quality property in a growing neighbourhood with professional tenants who'll treat it well. So with those factors in mind, Larissa on our team has been identifying 3 areas that tick all those boxes and really make that £50,000 budget work.
If you're hoping to attract professional tenants with stable jobs and reliable income, this first location is hard to beat. Most investors either overlook it as it's just another Midland city or assume that decent city centre apartments are out of reach on a 150k budget. But that's where they're wrong. Here, 150k still gets you a modern apartment right in the centre. Something stylish, easy to manage, and surrounded by major employers. Companies like Rolls-Royce, Toyota, and Bombardier are all based here, which means decent wages, stable employment, and strong rental demand from professionals who want to live close to work. And despite all of that, property prices remain surprisingly affordable, which gives you the ideal balance of yield and long-term growth. The city's also undergoing a huge regeneration push. New developments, better transport links, and an upgraded city centre are all making it a genuinely appealing place to live. It's not flashy, and that's exactly what makes it work. Steady, dependable returns from quality tenants in a growing market. So if you want a solid, low-hassle investment that still has room to grow, Derby should definitely be on your radar. But if you're looking for something completely different, this next location could be perfect for you. Because if you prefer something simple, steady, and low stress, the kind of property you can buy, rent out, and barely think about again, this next area is exactly that. A lot of investors overlook it because it's not trendy or exciting. They think they need to be in city centres or up-and-coming hotspots to make real money. But that couldn't be further from the truth, because there are countless commuter towns between Sheffield and Lincoln delivering some of the easiest and most reliable returns in the country. You can still find brand new 3-bedroom family homes here for around 150k. In fact, we recently did a deal in Gainsborough for exactly that price. It rents easily to a working family, offers a fantastic yield, and has solid capital growth potential over time, the definition of a set and forget investment. Because once you've found good tenants and a local letting agent, you'll get consistent rental income, minimal management headaches, and the peace of mind that your property's quietly growing in value. So if you want something easy and dependable, look for new build family homes in established commuter towns. It's not particularly exciting, and you might not get the explosive growth that comes with buying in a city centre at just the right time. But it's the easiest type of property investment there is. Now, if you want something with a bit more buzz, something that's already seeing investment pour in and still has plenty more to come, this next location is a perfect fit. Most investors focus entirely on Manchester city centre, convinced that that's where all the opportunities lie. But what they miss is the ripple effect, spreading out to the surrounding towns. And that's where the best value is right now. This town has been transforming over the past few years. New developments are springing up. Transport links to Manchester have improved, and regeneration projects are reshaping the local economy. Tenants love it because they can live close to Manchester without paying city centre prices. And investors love it because yields are often better than what you'll find in the city itself. And that's why Bolton is such a smart choice for anyone investing around 50k. Add your 100k mortgage and you can secure a modern apartment for young professionals or a family terrace with outdoor space, both in areas that are genuinely on the up. And if you can't find the right property there, neighbouring towns like Wigan are also benefiting from the same ripple effect. The key here is to focus on spots with good connections into Manchester and in zones undergoing regeneration. Yes, you're buying in Bolton, but you're buying into Manchester's growth story at a fraction of the price.
So hopefully you've now got a clear idea of where to buy and where to avoid. But that's only half the picture. Because 2 investors can buy on the very same street, and one walks away with a brilliant deal while the other overpays for a property that barely performs. And the key difference is in how they find these deals. So check out this video next, where I explain how to find better deals than 99% of investors.